Hello. Hello, and welcome to this edition of Joe and Paul's Another Mining Podcast with me, your host, Paul Harris, America's editor at Mining Journal, and Joe Mazumdar, editor of Exploration Insights. Hello, Joe. How are you?
How's it going, Paul? Glad to be here, and glad we have a pretty good guest here to help us understand exploration with respect to major companies. We have the exploration
Let's start that again, Joe. Someone's going to introduce Rob. Yeah.
Buggered up. You would introduce him first, and then we can.
So you just say hello, and then I'll go in to introduce Rob. Okay.
Sorry.
No worries.
Ahead of myself. I'll just have another whiskey. Hang on.
Okay, you put it down and I'll start again.
Okay.
Here we go. Hello, and welcome to this edition of Joe and Paul's Another Mining Podcast with me, your host, Paul Harris, America's editor at Mining Journal, and Joe Mazumdar, editor of Exploration Insights. Hello, Joe. How are you?
How's it going, Paul?
Very well, thank you. Many junior explorers dream of doing a deal with a major and eventually being takeout. For most, this is no more than a dream, but for a lucky few, it can mean incredible wealth generation. We have a very special guest today who's going to give us some insight into that and the world of exploration at a major mining company. So I'd like to welcome Rob Krcmarov, EVP of Exploration and Growth at Barrick Gold. Hello, Rob. How are you? Tell us who you are and what you do.
Well, hello, Paul, and hello, Joe, and thanks for inviting me on this podcast. I head up the exploration group. I initially graduated from Adelaide University in Australia. I did my honours at Olympic Dam, and I guess in a way, I was probably destined to join WMC through their program in a mine geology role. But really, I guess my passion was always in exploration. And I was very fortunate in that when I came out into the industry, it was a very good part of the job cycle. And so I had 3 other offers when I graduated. So I started with Homestake over 33 years ago. I worked through various parts of Australia. I eventually went back to university. I went to Codes, University of Tasmania, in the early to mid 1990s. And I really learned a lot. That was really quite formative for my technical development. I had worked throughout a lot of Australia, different ore deposit models from basically the Paleozoic through the Archean terrains. And at the time, I expressed an interest to my boss at the time of to complete my technical learning. I wouldn't mind working in a younger volcanic terrain. And so about a year later, he calls me up and I got an offer to go to Chile, where I spent three years. And so that was really a fascinating experience. I returned to Australia a little bit prematurely because Homestake had acquired plutonic resources, and so it was plutonic had a very large portfolio base in Australia, and so I was asked to go back, and I did quite a few years of mine-based exploration work, which again I learned a fair bit. Eventually, I moved to a more commercial role, so like a new business role, and that really had quite a profound impact, I guess, on my developing career. Learning more about the commercial aspects of the job. In 2001, Homestake, I guess it was a technical merger with Barrick, and I thought I'd be out of a job because I was in a very unusual role. But my boss and mentor at the time, he decided to retire, and to my surprise, I was appointed the exploration manager of Australia. I was reporting to Alex Davidson. He was my boss, and I was working very closely with Francois Robert, who's really one of the most best and practical geologists I've ever met. Both are still, I'm in contact with both of them. They're still friends and mentors to this day. And eventually, Asia and Africa, they were added to my responsibilities. And then in early 2005, Alex asked me to come to Toronto and head up global exploration. So I've effectively been running Barrick's global exploration group for about the last 16 years and have been part of Barrick's executive committee for the past 12.
Thank you. I mean, I imagine you're going to give us a lot of insights about exploration at a major today. I mean, to start off, we want to really sort of get into this. So exploration at a major gold company, what does it aim to do? Are you just focused on replacing depleted reserves, or is the discovery of new tier 1 assets, potential for growth, is that equally or more important?
I mean, we're in a pretty unique business in that our resource basically gets depleted from the moment that we start sharing it, the moment that we start mining it. I'm sorry, I'm having computer difficulties here.
Well, we can see you all right. We're good. I mean, can you see the screen okay?
No, just hang on a sec.
All right. You can cut this out, Paul, can't you?
Yeah.
Sorry, guys. Okay. So I'll just start again to answer your question, right?
Yeah.
Okay. So we're in a pretty unique business. We deplete our resource base the day that we start mining. And so really the fundamental goal of the exploration group is to at least replenish the reserves with at least the same quality as the material that we're mining. And so, you know, we need to have a long-term sustainable business that essentially delivers value to the shareholders, to the communities and the governments. And that's a really important part of it. We need to be able to share those benefits. And so our exploration group, we've got, we kind of wear multiple hats. And the first one is really, the first, I guess, main function is really our bread and butter. And that's to make sure that we work with our mineral resource managers and we feed projects of a short to medium term nature, and that could basically help improve the mine plan. So most of our work in exploration is really looking at augmenting, you know, kind of four years plus out. And that's the bread and butter stuff, and that's the stuff that we call brownfields exploration. And I guess I've got to say that historically it was done fairly poorly in Barrick, and that's something that Bristow has really brought to the table in the new Barrick, I guess. We've made some real progress in that area. Secondly, there's really the, what you mentioned, Paul, there's the hunt for the next addition to our tier 1 portfolio. And so while brownfields really optimizes the existing assets, that new tier 1 discovery, that's going to represent pure growth. And we've certainly had our success in making those tier 1 discoveries organically. And then there's really the optimization of the value of some of our major undeveloped projects like Pascua-Lama and Alturas and Donlin and stuff like that. And so our geologists need to make sure that we de-risk the resource model going forwards, and that'll ultimately lead to improved mine plans.
So when you're looking at this production profile for our viewers, I mean, it looks pretty flat. Is exploration and growth more about just keeping, is flat the new up in terms of just because you and Newmont and some of these big companies are looking at 5 million ounces a year of depletion? Is just geologically is this the way it is? You can't get that 3 to 5% growth anymore?
I mean, it's obviously difficult to grow, and if it was easy, everyone would be doing it, but you really have to ask yourself, what is it you're trying to grow? And so right now you can see in front of you a fairly high confidence 10-year plan. So we've got visibility for at least 10 years out. And it's obviously relatively stable around that 4.5 to 5 million ounce mark. But really by driving the costs down and getting high quality ounces like Goldrush, for example, which is high grade, that's coming on stream very shortly. We're gonna have margin expansion, and that's going to lead to growing cash flows. Also, for example, if we eventually add the even higher grade 4 Mile deposit, which is just basically past discovery stage, and we're now starting to put resources around that. Once that gets in the 10-year plan, we'll just continue to expand the margins and grow the cash flows. And then, of course, we will eventually make a tier 1 discovery. It's not easy, but we will make one. And if it requires some sort of standalone processing facility, or it's in a new country or whatever, that'll step up our longer term production profile. And, you know, I have to say, we have made tier 1 discoveries in the past, and I expect that we'll do it again. It is difficult, but it will come.
So is this production profile your reserve plan, or does it include resources and maybe some inferred projects that you think that you'll bring into reserves as well by that time?
It included some resources. I need to be careful here because I can't remember the detail behind it, but it's
okay.
It is a high confidence plan. That's what I can say.
Well,
okay.
One thing this chart doesn't show is the sort of average grade that you'll be producing. You mentioned that, you know, part of the aim is to maintain the grade or increase it, but obviously we're in an industry with depleting resources, and grade declines as part of that. So
I would correct you there, Paul. I think what Rob was saying, maintain quality, not necessarily grade, because if you've got a heap leach or something that's huge, you know, it'll be lower grade than a refractory underground deposit, but it potentially could be better margin.
Yeah. Correct. But I mean, I have to say that we already have, I think, the industry's highest reserve grade already by a significant amount, actually. And then when you look at the production that's coming in the next year or so from Goldrush, that's essentially almost a 10-gram ore body, and 4 miles probably even higher than that. So it's both grade and margin. Yeah.
So I mean, Barrick spends about, well, your budget is about 280 or 320 million, I think, for this year, which I roughly calculated about 2.5% of your revenue. So I just wanted to ask, like, in terms of, you know, exploration to keep people, you know, it's a cyclical industry, and the issue had always been that, oh, hey, exploration is a cost center, and if we got to cut costs G&A, we cut exploration. Is there sort of a thought process to say, okay, we're going to maintain it at a number level or a percentage level to keep that infrastructure for exploration and maintain that, let's say, resource with the people, human resource going?
Yeah, so I'll just give you a bit of detail on that number that you mentioned. So the exploration component is 230 to 250.
Okay.
There's another 50 to 70 million for
projects. Yeah. Okay.
It's that 230 to 250 range, and I think your revenue calculation sounds about right. But I don't think it's just about the level of exploration spending that's important. It's basically the results that you generate that really matter. And so a few years ago, we did a comparative analysis of some of our competitors, and there were some competitor companies that were spending a significantly greater percentage, and I think in one case more than double, I think, but we're having very little to show for it. In Barrick, we've got a relatively stable budget. It doesn't fluctuate so much these days, but we've got plenty of opportunity to reallocate to even better targets, to add new projects, during the year. And it's like managing, I guess, any portfolio. You continually evaluate and you reprioritize your investments. And so the idea is to, continually upgrade that portfolio and the project pipeline, keep it mean and lean, make it competitive, because that's what forces the discipline. And, when we make a discovery, then obviously we'll obtain some special funding outside of that base level budget. It also helps having Mark Bristow as a geologist. He understands the value proposition. It doesn't need to be explained to him. He completely understands that the fundamental value driver for the whole industry is really the quality ore body and what you do with it.
And how does that sort of 230, 250 million break down between sort of greenfield, brownfield, and let's put in a sort of exploration strategic joint ventures? It's
a difficult question to answer because it depends on how you define greenfields. So, for example, in Nevada, you could argue that it's all brownfields, but really some of the, Goldrush, for example, that was 6 or 7 kilometers away from the Cortez Hills operation, and that was in a greenfields environment. It had some legacy historic holes. No one had really properly tagged an ore body, and so you could argue that was a grassroots discovery. And so in Nevada, for example, we've got a pretty good balance between shooting for the moon and looking at some really bold conceptual plays, where we'd routinely drill a +1 to maybe 2 kilometer deep hole, really just to understand the geological framework or to test the concept. And then we balance that up with working with our MRM colleagues to make sure that we keep augmenting and improving the life of mine plan for the shorter term. In places like Latin America, we only manage ourselves 2 operations, and so the challenge there is more about growth and adding to the portfolio, and so it's a little bit more greenfields biased in that case there.
So this slide for our viewers shows that, if you're a big company and you have to replete 5 million ounces a year, then, to move the needle, you need assets that are capable of, giving you a huge production profile. And as Barrick's pointing out here, that you own or operate 5 of the 10 largest. I'm not sure if this is attributable or just the entire operation. But going forward, I guess, like, grassroots, brownfields, geologically, you put out this slide about the different types of deposit styles, whether they're greenstone belts, which are in older rocks, porphyries, which can be in old and young rocks, and different styles of, but the if you can explain it, so the dark yellow brownish color is basically telling you the proportion of these types of deposits that are, I guess, operating that yield these big deposits. Is that correct?
Yeah, so for example, if you look at that left-hand panel, out of the 671 deposits, and this slide was put together quite some years ago, but it's more or less not going to change that much. If you find a 3 million ounce greenstone belt deposit, there's only a relatively small proportion, 22% of them are going to get all the way to 10. Whereas you look at something like a porphyry, once you find a porphyry, it's very likely that it's going to get to 10 quite quickly, almost 50-50 odds.
Okay. So, and then you get to the grade part that the porphyry is not going to give you the kind of grade that a greenstone belt will, or, you know, let's say a Carlin will.
Correct. Yeah. So Carlins are obviously attractive. There are Carlin type deposits around the world, but the Great Basin in Nevada is unique for the size and the grade. It is really just phenomenal. I mean, we have explored for Carlin type deposits in Australia, with our joint venture partners, ATAC in the Yukon,
Yeah.
other parts of the world, but really so far nothing quite like the Great Basin.
But Carlin, like, you know, the refractory sulfide nature of the ore, you know, requires infrastructure, does it not? That you know, it's not easy to put this anywhere.
Yeah, exactly. So in the Great Basin, there actually are some oxide and heap leach deposits. Not all of them are Carlin type deposits.
Yeah.
But really, a lot of them are refractory. So generally, they'll go to a roaster or an autoclave, and so that obviously does require infrastructure. And really, because there were Carlin type deposits all over northeastern Nevada, and they were split up between processing facilities that were owned by Newmont and Barrick Gold, it made complete sense to actually rationalize all that and determine the optimum routing instead of like the Turquoise Ridge situation where Newmont had a 25% interest in Turquoise Ridge, and we were constrained with how much we could process at their neighboring Twin Creeks facilities. They were bringing ore from the other side of the state to Twin Creeks. It didn't really make a lot for either party, so it was a marriage that was always meant to occur. It just took a while to get there.
So when you look at this, or our viewers are looking at this, you're blending the types of deposit to get volume as well as to get grade, I guess. Is that fair?
Yeah, I guess the purpose of this slide is that not all deposits are equal, and so you know, in a low gold price or copper price environment, porphyries are not that attractive. In fact, quite often they can lose a lot of money. But greenstones, just generally because they're very high grade, they're always going to be attractive through most parts of the commodity price cycle. And the other thing I'd say is, as geologists, we're pretty mindful of the characteristics of the deposits, and we've just had a discussion about some of those characteristics. So deposits like VMSs, for example, and low sulfidation epithermals, they rarely meet tier 1 criteria, but really they can be such high grade and really make tier 1 type profits. And we wouldn't dismiss them outright, but we'd be selective in which of these types of deposits we'd work on. And so that's one of the opportunities that we see with Japan Gold. You know, they've basically have a first mover advantage in Japan. They've staked a lot of land. They've got a good quality team. And really, Japan hosts one of the world's best low sulfidation epithermal veins at Hishikari. Yeah. It's been producing around about 200,000 ounces per year for many decades now. It's about I think it's like a 40 gram per ton head grade. Yeah. And it's not optimized for production. It's more about having stable production. And so we want to see whether whether turning over some of these, whether something really can produce tier 1 cash flows will pop out.
Just a big thing on the porphyry part, like how much copper can you incorporate into like Barrick Gold? And then like you say, it's very cyclical, you know, whether porphyries being attractive and non-attractive. But you know, even though the cyclicality you've got to deal with, these deposits are 20 years long or 30 years long.
Yeah. So I only got a part of your message, but I think what I heard was how much copper can we take on. I don't really know the answer to that. It's really one for the investors, but I guess the rule of thumb used to be somewhere around 20 or 30% revenue mix. That was a threshold. But I think that was really more important when gold companies were trading at a greater than 2 times NAV. So when I started my career, it was like 2.5 times NAV for Homestake. And base metal companies, they were trading around 1 times NAV or perhaps even a little bit lower. And so, at Barrick, we're already copper producers. We're producing from 3 really very different ore deposit types with different processing streams in 3 different countries, actually. And so our copper mines, they help fund our gold business. And at the moment, I don't think any of our investors would begrudge us having, generating some really significant cash flows from our copper business. And I think perhaps just as important as the production mix is really, making sure that you run a sustainable and profitable business, and having a dividend policy that is predictable and that it rewards our shareholders. But again, that's really a question for the investors and perhaps our CEO. But I'll be interested in your thoughts.
Well, Barrick President and CEO Mark Bristow, I think he's openly commented or publicly commented that the company wants more copper. And obviously one of the advantages of a porphyry copper gold deposit in the context of what you've just said, Rob, is that they're multi-generational deposits that can sustain cash flows and underpin a dividend policy long into the future. So, that's obviously fed down into the company. So is that changed a little bit how and what you're exploring for? Are you actively looking for more copper in where you're going?
We are. Some of our properties already have very good copper potential, and we're actually in the middle of developing a copper strategy. Now, what we do with that needs a bigger discussion. Once again, circle back with Mark. But yes, we're very much thinking about copper and developing our exploration strategy on what we would do if we were to go there.
Yeah, well, I mean, previously when Barrick, purchased Lumaana or Equinox, I mean, that had a very negative impact, probably because of what you were talking about, the 2+ multiple for the gold and the 0.8 or whatever for base metals. But you think that now, that wouldn't be as big a deal?
Well, I don't know. Again, you have to ask the investors. But the other thing I'd remind you about Lumaana is that we bought it at close to the top of the copper price cycle. So it was very poorly timed.
Yeah.
And it was a fledgling asset operated by a junior company, and costs were very, very high. And we surprised the investors. We weren't as transparent as we should have seen. So hindsight's a wonderful thing. But as you've determined from Mark Bristow, he's very transparent. He will tell the investors exactly where his head's at, and we'll focus on quality. Again, it's that tier 1 quality that we're after.
Okay. Don't know what's going on with the slide, but you've let me just get back on this one and share it again. Some problems moving it. Anyway, sorry. When you talk geographically about where you want to be to basically be able to find these tier 1 assets, I see on your slide here that, you're all over the place with greenstone belts in Eastern Canada, Guyana Shield in Africa, but also porphyry potential, Western Cordillera, Carlin stuff, Southwest US. Like, how do you allocate that 230 million in terms of where you want to be, and which I guess you're sort of saying that here's the operating centers, but here's areas we want to actually enter.
Yeah, correct. So we're already in some of the world's best gold districts. Actually, what this slide shows is where all the 10 million ounce deposits are. And so that shows the clustering, and we're already in most of these jurisdictions. And so, the earlier slide, tier 1 deposits are pretty rare. And so we've got to go where the gold is. And as a general remark, we can choose where we want to invest our exploration funds to find that tier 1 discovery. And so really, fundamentally, you're looking at risk-adjusted returns. And, I guess in Barrick, we've kind of founded our business on really the whole principle of partnerships and sharing, and not just some sort of commercial transaction. Something that's adversarial and some sort of zero-sum game. That is a big difference that Mark has brought to our company. And in terms of selecting jurisdictions, I'm talking about non-geological things at the moment. there needs to be an exclusive right on going from exploration to exploitation. So countries like Russia and a few others where that's not the case, that's definitely a showstopper for us. So we're not there, no matter how prospective they are, there's just no point. And the other thing that we consider is, the financial regime in countries. So one of our, while countries can adjust the royalty rates and state participation, for example, if we can't see a pathway to 50-50 sharing of the benefits, then we'll decrease the investments, or we won't even go there in the first place. And so to that end, we've basically modelled a couple of hypothetical gold deposits, 3, 4, and 5 million ounce gold deposits, open pit, and we've done an evaluation of something like about 20 or 30 countries, and to understand the impact of changes in the royalty and state participation, free carried interest, and so on. And we've put in a whole bunch of base fiscal inputs, royalties, import-export duties, accelerated depreciation, state participation, corporate taxes, all that sort of stuff. And you can get a benchmark as to how competitive the countries are. And so if you want to produce tier 1 cash flows from tier 1 deposits and get a fair share of the benefits, you actually have to understand what the investment climate is like in some of those countries. And so we go in with our eyes wide open. So if a country wants to increase their taxes or they want a state participation or whatever, we need to see that however that we divide that pie, that there's got to be a clear path to 50-50. So that's the non-geological aspect. Geologically, we have scale-dependent area selection criteria on what we think distinguishes the tier 1 deposits from the other from smaller deposits. And they're at the regional scale, at the camp scale, and at the local scale. And we use those criteria to essentially prioritize and rank our projects. And so it's not the flashiest presentation and the most persuasive presentation and highlighting all the good aspects of a project. We have a very rigorous debate that's fact-based and evidence-based. And that's how we rank our projects, and that's how we choose to explore.
Rob, Barrick often goes into sort of jurisdictions where your peers fear to tread. I mean, how does that translate into what the company expects in terms of the premium for that greater risk? Projects in, let's say, perceived riskier jurisdictions, are they expected to generate a higher IRR than in safer jurisdictions?
Yeah, of course, we would adjust the discount rate if we were assessing a risky jurisdiction. But I guess it also comes down to the definition of risk. So what's perceived as risky for one company is probably risky for them because they don't really understand how to mitigate the risks. And, again, I have to take my hat off to Bristow. Like he goes to site, he meets with heads of state, with local communities, with trade union leaders, with whoever he needs to meet. And he does it regularly and really frequently. He doesn't shy away from media. He's a very transparent person. And so he focuses on understanding whether we can mitigate those risks, and if we can, putting in a robust plan to address them. And so what's risky for some is maybe not as risky for us because there's already a record of being able to operate in what are perceived to be risky jurisdictions. And I think being able to reach a favourable, a good resolution in Tanzania and in Porgera, I think that's really testament to the abilities of doing that.
Well, it certainly gives you a certain, let's say, competitive advantage, having that sort of framework or structure to be able to do that. Yeah,
but obviously we're not going to do anything reckless. We do a proper and thorough analysis before we do anything.
Well, like countries like the DRC, I mean, there's not very many companies that will go there. You obviously got a tier 1 asset there. Is like that greenstone belt going into Tanzania, is that more of a place that you think you've got, a competitive advantage that nobody else wants to be there, so you've got more free reign, or are you entering Egypt ahead of others?
Yeah, I mean, we have to go where the gold is, and we love it when some of our competitors who maybe don't understand the full picture or don't have the experience hesitate to compete against us in those areas. That's fantastic. In Egypt, one of the things that draws us there is we already have a regional presence. We have an operating copper mine, Jabal Sayid, in Saudi Arabia. There's that whole Arabian-Nubian shield, which is probably a little bit underdone. And then one of those orange dots on that map there is Sakari. I don't know if it's still a tier 1, but it used to be a tier 1 not that long ago.
Yeah.
And so already evidence that there's, maybe this is where the next emerging hotspot is. And so, when Egypt started to open up to foreign direct investment and welcome investors, we thought, well, let's participate and establish a view as to whether we'd be here for the long term. It's certainly permissive.
So, exploration, like you said, is organic. You're spending your money with your own people, doing your own exploration, but alternatively, you can invest in a junior, as Paul mentioned in the outset. So when you look at a junior, you've already picked it because of you want to be in that area, and then you just find out that they have most of the ground and a competitive advantage and want to make a deal with them. Is that how it sort of works?
It can happen either way. So in the case of, I'll just use Japan again. It was actually John Proust that approached us and alerted us to the opportunity that they had this first mover advantage. And so ultimately, we ended up structuring some sort of alliance that worked for both of us, that gave us the opportunity to assess the projects and basically form a view. And if there are any projects that meet our criteria, we could manage them. In this case, they already had a very capable team in the country, and I didn't really want to open up a new office there. And we thought, well, we screened this, let's work together, let's develop the projects together, we'll use our funds, and if we see something that we like, we'll quarantine that, and then we'll take it through to a feasibility study and earn a majority interest, and that helps Japan Gold control their potential dilution and stuff like that. And so in this case, it's a very collaborative alliance, I guess, and where we have a lot of technical input. In fact, we have a veto on any program or budget, but we're very happy with our joint venture partners. They're doing all the right things, and so it makes sense for them to continue. But as soon as we find something that might look like a project of interest to Barrick, we will eventually transition into managing it ourselves and then advancing it as quickly as we can up the resource triangle.
So just to understand, like when you do these joint ventures, like you were saying that, it's a win-win, like news flow from the junior side as equity investors on the junior side, it's always been a hassle, when the major is operating. Are you more inclined to allow the junior, give them, monthly or more often updates such that they can feed their investing community?
Yeah, it really depends on what their needs are. We recognise that they have disclosure needs, and they need to keep their investors engaged and informed and all that sort of stuff. So whatever works, we can accommodate that for sure. The other thing I'd say about junior companies, just to finish the discussion, I guess, is that we don't really have any passive investments. I mean, we had done that in the past, but I guess more recently, we've decided that we're not going to be passive about anything. And so I'm aware that some of our competitors are pretty active in this space. That's not something that we do. But I will say that we will do a placement if it's really directly associated with a project of interest that we could spend the money in the ground to earn that majority of interest. And so I do think that that Barrick could be an excellent source of financing. I think some junior companies give away royalties way too easily. I don't think they really understand what the impact and how unattractive that could potentially make a project. So that's something we always wrestle with. Basically what Barrick can offer is basically a risk-free carry through to a bankable feasibility study, if that's what the partner wants. We don't really want to manage anyone's company. We don't want to provide any constraints on them, some sort of loan-to-own scheme or anything like that. The junior partner can go ahead and run their own company. We're really only focused on finding an economic deposit with a really high threshold. And so if we don't pass an initial evaluation, we'll return it unencumbered. And I would say that really, as I said, we'd be willing to negotiate on who manages the initial early stages of the project. Sometimes it makes sense for us to do it and sometimes not. So that's negotiable. We'll jointly design technical programs, build on any experience or input that the partner brings. So a true partnership, if you like. And if we're not successful after an initial evaluation phase, we'll return it completely unencumbered, so no problems. if the project does continue to meet our expectations, we'd set a very high initial earn-in threshold, and you can see that reflected in most of our joint earn-in proposals and alliances, a very high threshold. If we do have some success, then we'd negotiate some sort of mechanism where we could get some of our risk capital back. And, you know, if we're very successful, we'd obviously be prepared to sole fund it all the way through to PFS or BFS, at which point it should be pretty easy for the owner of the asset or the junior company to raise their own funds. Otherwise, we can even assist with financing packages and stuff like that for some sort of additional percentage.
So to wrap this up, I mean, we have the Precious Metals Summit coming up in September, and that's a place where I think there's been a growth of corporate attendees to that. Is that a place where you meet a lot of the juniors or potential companies that you want to joint venture with, and updates with companies?
I do. It's one of my favorite events of the year, actually, because you get to have one-on-one meetings with the junior companies. Usually my colleague, Marion Moroney, she usually sets up the meetings, and she's got a very good network of her own. And then I will pick and choose some of those meetings that I will participate with her. And then I'll also do side meetings on the side. But it's a much more intimate setting, and it's a little bit more of a serious conference. So I really enjoy it. I get a lot out of it, and you get to know the people on the other side and build relationships, and you get to ask questions and understand it.
Okay, lastly, I mean, we have had COVID for the last year and a half. And so how has that impacted the execution of your exploration programs and your budget?
I mean, we pride ourselves on being agile. And so like most other people, we ended up moving on to WebEx and Zoom type platforms. It's not ideal because I tend to spend a lot of time on site, and I tend to know all of our people and spend a considerable amount of time in the field. And that's where you get more than what's presented on a screen. You get that tacit knowledge that gets passed along. And you both would have experienced on long car rides to site or mule rides or whatever. You know, you just have banter and you develop ideas and stuff like that. So that's the part that I truly miss. Having said that, I've been reasonably mobile since last September. You know, I was initially very cautious, and actually, unfortunately, I ended up getting COVID when I was in Africa.
Oh.
But you know, having had COVID and got through it, and I've been doubly vaccinated now, you know, I continue to take all the precautions, and so I have been out and about, and the only thing that's precluded me from spending really any time in Latin America is their borders have essentially been closed, and so I'm looking to that opening up. But no, we've been pretty agile, and it's been not quite business as usual, but I certainly look forward to the pre-COVID days when they come back again.
All right. Paul?
Well, the last question I wanted to sort of throw at you, Rob, technology, changes in technology can make a big leap forward in mining and exploration. Are there any things you're seeing coming through that you're particularly excited about that you think may help revolutionize the way you go about your task?
I think there's been some significant developments in many fields, like the resolution that you're getting on some of these hyperspectral surveys. You know, you're getting down to, you know, less than a meter resolution, pixel resolution, and you can the bandwidths are getting larger and larger, and so you can discriminate more and more minerals. So that's on a very good trajectory. The invention of portable XRFs, that was, I guess it was about 15 years ago. That's been a very good development, and gradually the threshold for gold is getting lower and lower. It's still not at a useful stage yet, but we're kind of getting there. We're on the right path. That's been good. We were investors in trying to evolve drilling technology, which fundamentally hasn't really changed all that much. It's still pretty primitive and dangerous and very expensive and all that sort of stuff. And so we co-invested in some technology that was really looking at called tubing, that was flexible and steerable and assaying in real time and all that sort of stuff. But really, the next step is to take some of these prototypes and get them to a commercial stage, and I think that holds a lot of promise. But at the moment, I'm kind of still frustrated with how inefficient and dangerous drilling is.
Excellent, thank you. Well, I think that's all we've got time for today. So many thanks to Robert Krcmarov for joining us, and stay tuned for more from Joe and Paul's Another Mining podcast in the near future. Thanks, everyone, guys.
Thank you.
Thanks, Paul. Okay, hang on.
You need to hit stop.
Got it. Oh, that's stop video. Sorry.
Yeah.
What the hell?
Very professional.
Stop share.
We can have a good outtake roll at the end of the year for Christmas.
Am I still recording?
Yeah. Yes, you are.
Okay.